Well, good morning, everybody. It's April 17th. This is the weekly review where we take a look at what happened last week, project what should happen in the coming weeks. If we look at the gains last week, good gains across the board, in particular on the Russell. That was up 3%. The 3% number in that gain benefited greatly by the rally that we saw in the financials. In particular, it was some of the small cap banks, but the big move, of course, took place in the JP Morgan, Citigroup, Wells Fargo, those. We'll look at those numbers a little bit later, but that was the primary push that took place on the Russell, and it outperformed. On the year now, the NASDAQ is the laggard, 1.5% down compared to the other indexes. And we'll have to keep that in mind as we go through the stats here this morning. So on a technical side, it was another week this market just simply refused to back off. The takeaway bars that we saw last week, where we had those, that push down here, then the push back up on the next one, and then again back the other way, right? That set up last week to try and push back down. We went sideways 3 days and then we broke, or 2 days, and we broke out. And so once again, anything and everything that has to do with badness with this market continues to be erased, and the market continues to work higher. And I don't know how many times I've looked at this market and said, this may be the potential pullback, but every time we do, it just continues to push higher. I want to show you the weekly here on the S&P, because we had looked at the weekly and said to ourselves, okay, we have the potential, as we broke out on Wednesday, we had the potential to actually get a breakout on multiple time frames here on the S&P 500. It did touch, it did test, it actually tested with less volume. Again, that's a negative when it does something like that. So you actually had a test failure on the weekly time frame. I didn't highlight that this week because nothing seems to matter to this market, but that's something to keep in mind as we get going in the next week. Now, one place that we actually did get the breakout on multiple time frames was the Dow Jones itself. You had two swing point highs broken there. Here's the breakout on that swing point high. And so the Dow, even though it's the most narrow of the indexes, has actually confirmed a multi-swing point breakout on a weekly basis. And that usually augurs for 2 to 3 bars to the upside. And in this particular case, if it breaks another one, it would actually turn bullish on the weekly time frame. And so, in general, it's positive action still taking place pretty much across the board. That hasn't changed, and until it does, our attitude has to be to try to ride this as best we can to the top side. There's always something to worry about, but until those worries actually begin to become actualized, right, then we need to just simply stay with the trend. If we look here at the other major factors, the push-up last week was primarily a result of earnings season getting underway, and I wanted to point out, just how negative this market was on earnings coming in. If you look at these numbers and how the market reacted to them, JP Morgan, the revenues declined almost 4%. They were up 7% on the week. Bank of America, they declined 8% on the revenues, and they jumped almost 9%. Wells Fargo was the only one that actually showed an increase, up slightly. Citigroup declined 11% on the revenues. They were up 11% on the week. So you had huge gains in the financials. The market had already discounted them so much that they bought the news after selling off on the rumors. And that, again, just tells us how strong this market continues to be. One of the weaker groups out there sees a nice big rally. It's a large portion in terms of weighting of the S&P 500. And it seems like, the worse it is, the better the market reacts to it. As mentioned before, the Russell was the star performer last week. A big push-up, primarily off the KBE, the banking sector. If we look at the small caps, banks, here's the KBE breaking out, multiple swing point highs broken, right? And if you look at it on the weekly, it's an ABCD structure on the way up, with an A point, here at the lows, right there, the B point right up here, you get a C point there, and now the D point stretches up into this swing point lows high. And so it's a full retest. Regen looks like it's underway in this particular sector. If you got any kind of a pullback into this B point's top, it might be a place to try to put some on and try to ride this on the way up. When you look at this, and the KRE is set up the same way, it tells you that this sector is probably going to continue to support this market, and again just reflects the idea that this market is going to try and push farther, at least in the financial sector, which again is a large weighting both in the Russell and in the S&P 500. If we try to understand what potentially could happen here on the downside, the currency's still offering a lot of hints of potential pressure that could come into this market. And what I'm talking about is these pullbacks on the currencies here. They have shown that they're going to try to go sideways, and that's probably going to be true on the FXE into the Draghi meeting this weekend. What is it, Thursday, I believe they have their ECB meeting. This push up, right, if you look at it on a weekly basis, came into the swing point high, broke the swing point high, now it's doing a full retest, probably going to try to regenerate higher. If it goes higher, Euro's going to be putting pressure on the equities in the Eurozone. Same thing in Japan. Japan didn't get much of a pullback at all. If you look at it on the weekly, it was inside bar on a weekly after a big spike up. This looks to try and go higher too. That's also going to put pressure on the Japanese market. So we're seeing currencies still being an issue, and probably are going to continue to be an issue for some time. And finally, if we look at the bear market mentality, right, there's really everything to be bullish about. The big picture, though, is still that of a topping pattern, or at least that of a topping pattern, right? Because if we look at this and we just look at the monthly chart, right, and pull it up and say, okay, what's going on here? At best you got some sort of a big sideways. I shouldn't say at best, but right now we have some sort of a big sideways pattern. A lot of time those sideways patterns end up, after a long run like this, end up being some sort of a topping pattern. Now, that's not going to mean anything unless it actually tops, but right now the pattern is still in process and is still forming. So we have to keep that in the back of our mind that potentially there is some bearishness on the bigger picture. I shouldn't have said at best, but it's a large range starting to take place on this monthly chart. And the other thing, I guess, is that if we had to look at another factor in my mind as to this current rally, we've had better participation in the qualified trends. But a couple of years ago, when you saw the big move up in the S&P 500, right, when we were looking at this big, long, strong move, you had the bullish qualified trends at 2-to-1 versus the bearish on a consistent basis pretty much the whole way up. It's not that way now. And I guess it shouldn't be that way if you think about it, if you're really going sideways on a longer term trend. But that just tells us that unless we start seeing those bullish trends start to pick up and totally outnumber the bearish ones, then we have to be concerned that this still hasn't got the kind of juice that we saw back here, and that another leg higher from here is still something more of a pipe dream than a reality. So what's the bottom line here? The Fed's focus on keeping these markets elevated is just as strong now as it ever was. This whole rally off these S&P lows, and if we go back to the daily chart, this entire move, right, it started when Yellen basically said she was going to change what she looked at in terms of whether or not the Fed could raise rates. And that change was that we were not going to just focus on the U.S. anymore. We're going to look at the whole world. The whole world has to be showing us growth, or we're not going to raise rates. And that sent the dollar down, sent the market up, and the rest is history, right? And these Fed speakers, the ones that are going against Yellen, so far they don't mean anything. The ECB is this week. I can't see how they're going to do anything to push the euro lower, the dollar higher. So it looks to me like this whole move that's been in effect, commodities, equities, U.S., that is, we're going to see that continue to, gravitate towards these equities, at least for now, because the dollar doesn't look to me that it's going to go up in any appreciable way anytime soon. And so this whole rally off the lows looks to me like at least we're going to go sideways and try to work this off on a sideways move at best for now. And if we are going to get some sort of a pullback, it's going to happen when this market perceives that the dollar is going to start to continue its rally higher. And I don't frankly know when that's going to be, because right now there's no indication of it. What's the best case? We actually, in terms of the next week, a push higher, a break of that swing point high would probably be the best case. I think you're going to see more consolidation than you see of anything else here now. Worst case, probably a fast trip back down, just like we were thinking last week. The most likely case is it's going to be very choppy this week. We're going to see it up and down, and I don't really have a bias either way as to which way that will play out. On a fundamental basis, earnings getting to a full swing this week. We're going to get more peak at tech, which has been the weakest sector, the weakest group. Usually the markets don't do well on a long period of time if technology is not driving the action, and right now it isn't. So as we get into some of those earnings this week in tech stocks, and especially next week, then we're going to find out if we're going to get another leg higher or not. The ECB is going to have a hard time doing anything with the euro and pushing it down. I think the biggest wild card out there is the meeting that's taking place today. That's the oil meeting, because I think you could see a 10 or 15% move in oil even in a week based on what comes out of that meeting. And so that's the big wild card. So at this point, it looks to me like it's more of the same. Market's going to try to hold up here. It's going to hang up here. It's probably going to do some sort of a sideways trend. And if we go back and look at the S&P 500 and put it on a weekly basis, some sort of a consolidation period up here where the S&P just simply works sideways versus any kind of a move to the upside or the downside looks to be much more likely of the case of what we probably could see and expect in the coming weeks, something more like that. So that's where we're at. I'll be keeping track of what's going on and advising you as to what I think, and hopefully we can continue to trade these markets successfully even in these trying times. Take care. Thanks.